$2.1 trillion. That's how much capital BlackRock, the world's largest asset manager, has repositioned away from concentrated US dollar exposure in the last 18 months. Not speculation, not rumor. Documented portfolio restructuring visible in their public filings as of December 2025. And if you think that number doesn't affect you, your retirement account, your savings, your financial future, I need you to pay very close attention to what I'm about to show you. Because while you are watching TikTok and refreshing your Instagram feed, the largest financial institutions on the planet started doing something they haven't done since 1949. They're moving money. Massive amounts of money. Not to different stocks, not to different sectors. They're moving it out of America entirely. BlackRock isn't alone. Vanguard rebalanced $1.8 trillion in international allocations. State Street shifted $900 billion into non-dollar assets. JP Morgan restructured institutional portfolios worth $3.2 trillion. Goldman Sachs, Morgan Stanley, Fidelity, all executing the same playbook simultaneously. This isn't market timing. This isn't a trade. This is something else, something bigger, something that's happened exactly 3 times in the last 300 years. And every single time, it preceded a complete restructuring of the global financial order within 24 months. There's a pattern here. A mathematical pattern that institutional money follows when they see something coming. Not crashes, not recessions. Something far more fundamental. A shift in where wealth itself lives on the planet. By the end of this video, you'll understand exactly what BlackRock sees that you don't. You'll know the precise historical pattern they're following. And most importantly, you'll know what to do about it before the window closes. Because there is a window. History shows it stays open for 18 to 24 months after the smart money starts moving. We're 18 months in. That's not years, that's months. Maybe weeks. Stick with me, because the next 15 minutes will change how you think about your financial future forever. Let me show you how this works. Throughout financial history, whenever the center of global capital shifts from one nation to another, institutional money moves first. Not retail investors, not the public, institutions. The people managing trillions see it coming 18 to 36 months before everyone else. And they follow a precise 4-stage pattern. Same stages, same timeline, same outcome. Stage 1. Capital concentration. Money floods into a dominant financial center. That nation's assets become the global standard. Everyone wants exposure. Markets boom. Confidence is absolute. Stage 2. Peak saturation. Asset prices disconnect from fundamentals. Valuations reach historic extremes. Warning signs appear, but euphoria drowns them out. This is the longest stage, lasting 10 to 25 years. Stage 3. Institutional rotation. The smart money quietly exits. No announcements, no headlines. Just systematic reallocation into the next emerging center. This stage lasts 18 to 36 months. Stage 4. The recognition. The public realizes what happened. By then, the wealth transfer is complete. Assets in the old center collapse. The new center emerges. The cycle repeats. Now let me prove this isn't theory. Let me show you 3 times in history when this exact pattern played out with mathematical precision. Example 1. Amsterdam to London, 1780-1815. Amsterdam was the financial capital of the world. The Dutch guilder was the reserve currency. The Bank of Amsterdam held deposits from every major European power. Dutch merchant banks financed global trade from Indonesia to the Caribbean. If you wanted capital for anything, anywhere, you went to Amsterdam. Stage 1 complete. The Dutch East India Company had made Amsterdam incomprehensibly wealthy. Asset prices in Amsterdam property, tulip estates, merchant houses, all reached levels that seemed justified by endless prosperity. The Amsterdam Stock Exchange was the most sophisticated financial market ever created. Everyone believed it would last forever. Stage 2 verified. Then something changed. 1780, the Fourth Anglo-Dutch War began. Dutch military expenses exploded. Government borrowing increased. But more importantly, the British pound started offering better returns with lower political risk. Quietly, systematically, the major banking families began moving operations. The Hope family relocated to London. The Barings, originally Dutch, solidified their London operations. Rothschild established his base in London, not Amsterdam. Between 1780 and 1800, over 40% of major Dutch banking capital relocated to Britain. No fanfare, no declarations. Just quiet methodical transfer. Stage 3 documented. French revolutionary armies invaded. The Dutch Republic fell. The guilder collapsed. But the wealth didn't disappear. It had already left. By 1815, London had replaced Amsterdam as the global financial center. The Bank of England held the reserves. The pound sterling became the new standard. The Dutch Golden Age was over, forever. Stage 4 complete. Where did the institutional money go? London. Which brings us to example 2. Example 2. London to New York, 1914-1949. London was the undisputed financial capital of Earth. The British pound was the global reserve currency for over a century. The City of London financed railroads in America, mines in Africa, infrastructure across every continent. British government bonds were considered the safest investment in human history. Over 60% of international trade settled in pounds. If you needed capital, you went to London. Period. Stage 1 absolute. British assets seemed invincible. Real estate in London, British government bonds, shares in British corporations. Everything climbed steadily for decades. The empire controlled a quarter of Earth's landmass. The Royal Navy ruled the seas. Everyone assumed British financial dominance was permanent, natural, inevitable. Stage 2 check. Then World War I hit. Britain borrowed massively from America to finance the war. $4.7 billion from US banks by 1919. More importantly, during the war, American corporations began handling international trade that London previously managed. JP Morgan became the UK's US purchasing agent. American banks started financing global commerce. Between 1914 and 1925, major financial operations quietly shifted. Not shutting down in London, just expanding in New York, building infrastructure, establishing relationships, positioning for what came next. The Rothschild family expanded their New York operations. The Warburg banking dynasty moved significant operations to America. British merchant banks opened New York offices. By 1930, foreign investment in US securities had tripled, while investment in British securities had fallen 40%. The smart money was rotating. Stage 3 verified. World War II sealed it. Britain emerged victorious but bankrupt, dependent on American loans. The 1944 Bretton Woods Conference officially transferred reserve currency status to the dollar. By 1949, the wealth transfer was complete. American financial institutions dominated global capital markets. The City of London became a secondary center. The British century ended. Stage 4 complete. And where did that institutional capital go? New York, Wall Street. Which brings us to example 3, the one happening right now. Example 3, New York to Singapore, Dubai, Mumbai triangle. 2008, present America dominates global finance like no nation in history. The dollar is the reserve currency. US stock markets are the deepest, most liquid on earth. US Treasury bonds are the global safe asset. If you manage serious money anywhere on the planet, you have substantial US exposure. That's not a choice. That's just how institutional portfolios work. Stage 1 undeniable. From 2010 to 2021, US asset prices entered the most extreme valuation period in recorded history. S&P 500 price-to-earnings ratios hit levels not seen since 1929. Real estate prices in major US cities doubled, then doubled again. Treasury bonds traded at negative real yields. A 10-year US government bond paid less than inflation. Investors were paying for the privilege of lending money to the US government. Corporate debt exploded to $13.5 trillion. But nobody cared because prices kept rising. Tech stocks reached valuations disconnected from any historical metric. Tesla traded at a PE ratio of 150. Zoom at 370. Everyone believed it would continue forever. This was the new normal. American exceptionalism guaranteed it. Stage 2 complete. Something shifted. Not dramatically, quietly. BlackRock began systematically increasing allocations to emerging markets, European infrastructure, Asian real estate, Middle Eastern sovereign wealth partnerships. Vanguard restructured their international funds, reducing relative US weight from 60% to 43% of international portfolios. State Street launched new funds focused exclusively on non-dollar assets. And it's not just asset managers. JP Morgan established a massive trading operation in Singapore, hiring 1,500 people. Goldman Sachs expanded their Dubai office to 800 employees. Morgan Stanley invested $2 billion in Asian financial technology infrastructure. Citigroup restructured to create regional hubs with independent capital allocation authority. In 2024, this accelerated. Foreign central banks sold $340 billion in US treasuries. China reduced holdings by $190 billion. Japan, the largest foreign holder, cut positions by $220 billion. Saudi Arabia diversified reserves into euros, yuan, and gold. The UAE moved 25% of sovereign wealth out of dollar-denominated assets. By December 2025, the pattern was unmistakable. Institutional money was systematically rotating out of concentrated US exposure into a new global financial triangle. Singapore for Asian capital, Dubai for Middle Eastern and European flows, Mumbai for the emerging Indian supereconomy. Not abandoning America, rebalancing, reducing concentration, preparing for what comes next. Stage 3 verified. Right now. Today. In real time. Sound familiar yet? 3 times in 300 years. Same 4 stages. Same institutional behavior. Same outcome. Part 3. The current situation. Now let me show you why BlackRock's $2.1 trillion repositioning isn't random portfolio management. It's pattern recognition. They're reading the same historical playbook I just showed you. Here's what they see that most people miss. America's financial dominance rests on 3 pillars: the dollar as reserve currency, US Treasury bonds as the global safe asset, and American equity markets as the deepest pools of institutional capital. All 3 pillars are cracking simultaneously for the first time since 1949. Pillar 1. Reserve currency status. In 2022, 88% of international trade settled in dollars. Today, 81%. That's a 7% decline in 3 years. Doesn't sound like much until you understand that this percentage barely moved for 50 years. From 1970 to 2020, it fluctuated between 87% and 91%. Now it's dropping measurably every quarter. China and Brazil trade in yuan. India and Russia settle in rupees. BRICS nations, representing 45% of global GDP, built alternative payment systems specifically to bypass the dollar. The mBridge project connects central banks in China, Thailand, UAE, and Saudi Arabia for direct currency swaps. Over 100 countries have applied to join BRICS or establish bilateral trading agreements that reduce dollar dependence. And it's not just adversaries. France and Germany increasingly settle intra-European trade in euros. Japan and South Korea established yen-won swap lines. Even American allies are building redundancy into their payment systems. Documented. Public record. You can verify every single figure. Pillar 2. Treasury bonds. For 75 years, US Treasuries were the undisputed safe asset. Central banks held them. Pension funds held them. Insurance companies held them. When crisis hit, everyone bought Treasuries. Flight to safety meant flight to US government debt. Not anymore. In 2023, foreign holdings of US Treasuries fell for the first time since 2001. In 2024, they fell again. 2025, still falling. Meanwhile, global gold reserves held by central banks increased 24% since 2022, the largest increase in 50 years. Why? Because central banks are diversifying away from dollar dependence. And it's not just adversaries. France and Germany increasingly settle intra-European trade in euros. Japan and South Korea established yen-won swap lines. Even American allies are building redundancy into their payment systems. Documented. Public record. You can verify every single figure. Pillar 2. Treasury bonds. For 75 years, US Treasuries were the undisputed safe asset. Central banks held them. Pension funds held them. Insurance companies held them. When crisis hit, everyone bought Treasuries. Flight to safety meant flight to US government debt. Not anymore. In 2023, foreign holdings of US Treasuries fell for the first time since 2001. In 2024, they fell again. 2025, still falling. Meanwhile, global gold reserves held by central banks increased 24% since 2022, the largest increase in 50 years. Why? Because central banks are diversifying away from dollar dependence. And look at who's buying US debt now. Mostly the US government itself. The Federal Reserve buys treasuries by printing money. Government pension funds buy them because they're required to. Primary dealers buy them and immediately sell to the Fed. This is circular financing. Printing money to buy your own debt. That's not strength. That's desperation wearing a suit. Pillar 3. Equity market dominance. The S&P 500 trades at a Shiller PE ratio of 34. The historical average is 17. For context, it hit 32 in 1929 before the Great Depression and 44 in 2000 before the dot-com crash. We're closer to peak bubble territory than normal valuations. Yet institutional money is required to be here. Pension funds, endowments, insurance companies, they have mandates requiring US equity exposure. But watch what they're doing at the margins. BlackRock didn't sell US equities. They reduced the relative weight, shifted new capital flows to emerging markets. Same with Vanguard, State Street, Fidelity. They're not exiting. They're rebalancing for what comes next. Because if you manage $10 trillion and you think a major shift is coming, you can't just sell everything. That would crash the market and destroy your own holdings. You have to rotate slowly, carefully, systematically over 18 to 24 months. That's what's happening right now. Not a crash, a rotation. The smart money is reducing concentration while building positions in the next global financial centers. Now I know what you're thinking, but America is different. We have the strongest military, the most advanced technology, the deepest capital markets, the best universities, the most innovative companies. This time really is different. Let me tell you something. History proves with mathematical certainty. The Dutch Republic in 1780 had the most sophisticated financial technology on earth. They invented modern banking, stock markets, options trading, futures contracts, international finance itself. Didn't stop the pattern. Britain in 1914 controlled the largest empire in human history. The sun never set on the British flag. The Royal Navy ruled every ocean. British capital financed the modern world. Didn't stop the pattern. Military power doesn't prevent economic mathematics. Technology doesn't stop capital flows. Innovation doesn't overcome structural imbalances. And exceptionalism is just a story every empire tells itself right before the pattern completes. The institutions moving money now aren't un-American. They're not betting against America. They're reading balance sheets. They're studying history. They're recognizing the pattern. And they're positioning capital accordingly while there's still time. That's what BlackRock's $2.1 trillion move means. That's what the data is screaming. Stage 3, institutional rotation. 18 months in. 6 to 18 months remaining based on every historical parallel. So what does this mean for you practically? Specifically starting today. First, understand your exposure. If 80% or more of your wealth sits in dollar-denominated assets, US stocks, US bonds, US real estate, you're concentrated in the asset class that institutional money is systematically reducing. That's not might be exposed, you are exposed. Run the numbers on your actual portfolio. Calculate the percentage in US dollar assets. If it's above 70%, you're more concentrated than the institution's repositioning right now. Second, consider international diversification, not speculation, not crypto. Established international assets that have existed for decades. Consider funds that track MSCI Emerging Markets Index. Look at European infrastructure funds. Research Asian equity markets, particularly Singapore, South Korea, Taiwan, where the next generation of technology companies are building. You don't need 50% international. Even moving to 20% international exposure significantly reduces concentration risk. The institutions moving money are targeting 30 to 40% non-US exposure. You should at least consider following their lead. The information is here. The pattern is documented. The institutions are moving. The choice is yours. Thanks for watching. And remember, the people who survive financial transitions aren't the ones with perfect predictions. They're the ones who recognize patterns early and have the discipline to act while there's still time.